was a doubt which you had at that point of time, because the PPT was showing a different formula, the formula which the slide in the PPT was showing.
Yes, ma'am. Profit after tax and profit before tax.
This is profit before interest and tax, and divided by initial capital cost. So this is what the formula says. So, but the solution what we have started solving from this set of information, what do we have? We have the cash flows are given. Cash flows are given from year 1 to year 4. Then we have taken cumulative cash flow. This is all what we have. Then um, there is no amount of there is no percentage of tax mentioned, or tax amounts are not given. So we written this yesterday. We wrote this one as average annual profit after tax divided by average investment. So I'll give a clarity about these two different formulae. Average investment. The condensed format of income statement is given as sales, cost of goods sold, gross profit, operating expenses, operating profit, the other things. So I hope you understand. I mean, were you there when this income statement format was given in the class?
Yes, ma'am. Yes, ma'am.
Okay, so you know this one. Now, in case of management accounting, the formula is explained as ROCE is explained as ROCE is equal to the profit. Return is profit on the total amount of capital employed, which is employed by raising the amounts from all types of investors, the debt holders and the shareholders. So the profit which is available to all the investors is EBIT. So the explanation about this one is given as EBIT divided by the amount of capital employed. So capital employed, that is what is the logic. And then again there is a variation also. It is taken as average capital employed. But when we come to financial management, this is according to management accounting. This is the explanation, because there is no standard format or standard formula as such for any ratio. It is useful for decision making. That's why management accounting is adopted. There is no such thing as a standard formula. So one variation of ROCE is the for the amount of capital which is employed, the what is the amount of profit available, return which is available on the capital employed. Financial management, its format is little different. It says that take the revenue or sales, take sales, from this deduct all expenses, less expenses which are both cash plus non-cash. Non-cash, very specifically, we refer to only depreciation. So this is the amount of profit. So there is no multiple steps which are usually considered for preparing the income statement, but the assumptions go in this particular fashion. So profit. So since profit on this profit tax is calculated less tax, but because we understand depreciation is a non-cash transaction, add depreciation, and then we have cash flow after tax. Sorry, this is less tax, profit after tax, then add back depreciation, then that is called as cash flow after tax. So the ROCE, or what we call it as ARR, is equal to, the formula talks about what is profit after tax divided by the average investment. So most of the financial management textbooks do not discuss about this form of this this ratio, these variables considered into the ratio, this is not discussed in financial management. This is also correct. The first one is correct. Second one is also correct. But depending on what is the situation, where is it more suitable, that has to be looked into. So here, the term which is the one which we are solving, the way it is addressed is calculate ROCE only. So that is what is given. What is based on the average investment method, what is the percentage return on capital employed of the investment to one decimal place? So is there any way that we can calculate what is EBIT? We do not have anything, any source in which from cash flows we can go back onto what is EBIT. Because to have EBIT, earnings before interest and tax, we should have so much more information. Because it is not there, we can conveniently go ahead with calculating or taking the profit after tax and then divided by average investment, for that reason. But we also have two questions from the short answer questions. We also have two questions. So I thought I'll take up those two questions also and then show you the variation. See, that is also an acceptable formula. This is also acceptable formula. So we need to have that understanding, thorough understanding about which one to use when. Okay. So if that is the case, if you are looking at what is the average annual profit after tax. So let's calculate this one. Is equal to. So take the average amount. Why would it not show? I don't know why is not showing. So take the average value of all the cash flows. What are the cash flows? I made a mistake. I'm sorry. So now we have to write what is the average annual profit after tax. The question has the cash flows given, not the profits. So here, what are we supposed to do is calculate what is profit after tax. So according to the what is the logic here? What is the difference between these two? Profit after tax and cash flow after tax. What do you see is the difference? Profit after tax,
Depreciation.
add depreciation is cash flow after tax. So we have cash flow after tax. So deduct depreciation to arrive at what is profit after tax. So take what is depreciation.
And do we have depreciation given in the question?
So the investment cost is 3.9 and
Then there's this formula, right, where you divide the total.
that's right. That's right.
Yeah.
No, I'm just searching. Do we have the method mentioned here in this question? The directors believe that this investment project will is the life only for 4 years? Is what I'm just looking into that. Um,
Excuse me, ma'am.
Yeah. There is nothing mentioned about the life of the project. So life is taken to be as 4 years. The only thing what we have the information is that there is a scrap value mentioned. Scrap value is 100. Apart from that, throughout this question, we do not see that there is any amount of or anything about the method of depreciation calculated. So the life is taken to be as 4 years. So what is depreciation? Depreciation is equal to, the formula of depreciation is equal to original cost minus salvage value. The whole thing divided by life. Life will be, we have to take it as life of the asset. Life of the asset is 4 years. So what is annual depreciation?
Ma'am, what will be taken as original cost?
3.9 million. 3.9 million is given there.
Yes, ma'am, 3.9.
Okay. So here it would be 3.9 or 3 million. 3,900 because it's in zeros. These are thousands. 3,900 minus 100. The entire thing divided by 4. 4 is, so this should be 3,800 divided by 4. 950. So,
950,000. Yes, ma'am.
so depreciation we have it as 950. Arrive at what is profit after tax. So profit after tax would be cash flow after tax minus the depreciation.
Why is there almost like more than 75% of depreciation each year?
I didn't get you. More than?
More than, like, the depreciation is 950,000 per year, right?
Yeah.
Isn't that a bit more than what the depreciation should be?
Is that so? Correct only, no? 3,800.
Okay. Yeah, salary value is 100. Okay.
Okay. So now let's find out what is the average value of these things.
Yes, ma'am.
Average annual cash flow after tax. I think this should be only this amount. Let's make it as 1580. 1580 minus 950. 100 is salvage value. ROCE is equal to. So we would have 520 in the numerator. Denominator should have 520 is there in the numerator. Denominator is average investment. The initial investment is 3,900. The final value is 100. The whole thing divided by 2. That gives us the average investment. So check that is equal to 520 divided by 4,000 divided by 2,000.
$13 by 50.
26%. This is average investment, isn't it?
Yes, ma'am.
Okay. So we have discussed both the variations. So I will also take you through one question of the formula wherein it is earnings before interest and tax. So there's another bit also C bit which says that which two of the following statements about investment appraisal methods are correct. The return on capital employed method considers the time value of money. Return on capital employed must be greater than cost of equity if a project is to be accepted. Riskier projects should be evaluated with shorter payback periods. Payback periods ignores the timing of cash flows within the payback period. So we have MCQs wherein more than one option is also selected. So here two options have to be selected. So how many options have to be selected would be clearly mentioned. So we need to very carefully look into that. Unless and until you mark them, two of them as correct, it would not proceed further. So you have to look into that and select as many number of correct answers are there or which you have to select. Talking about
A is incorrect.
A is not correct because
Yes,
these two things are not considering the ARR part and also the payback period. We have not considered about the discounting value of the money. So it is just whatever is the anticipated value, take these anticipated values and then proceed further with the formula.
yes,
So A is not correct. B says that return on capital employed must be greater than cost of capital. That is the situation with IRR, not ARR. ARR is only simply calculating what is the percentage of profit earned on the amount invested. So that is a simple thing, not anything in a relative sense comparing with the cost of capital. So that comes, that would be correct in case of IRR. We're going to start IRR in a while, in a short while now. Coming to, so we are left with only two, but let's justify whether they're correct or not. It says that riskiest projects should be evaluated with shorter payback periods. So that is a strategy which is generally considered even at times of pricing the products also. So here it says that if it is a riskier ones, so earlier the investment is paid back, it is better. Since it is riskier, by nature it is riskier, so why wait for a longer period of time to get back the investment amount? So the earlier the better. So that's so some of the products wherein huge costs are invested and then they also release the products with a higher price so that they can recover back all the costs which are incurred, electronics or electrical products. And also we see that the demand would not last, mobile phones, the demand would not last for very long period of time. So because of the technological advancement, so what do? While launching the products, they launch these products at a higher price. After a while the price comes down once their costs are recovered. So that is the strategy. So whenever we see that the investment is a riskier investment, it should be considered as having a shorter payback period. So that should be the strategy. D, so C is right. D says payback period ignores timing of cash flows within a payback period. How do we answer this one? Yesterday also, I explained to you that suppose if there is investment of minus 1000, okay, then this is minus 1000. Maybe project A, there are two projects, project A and project B. So if we see that evenly, if it has cash flow for 6 years period, something like that, let's see that. So overall, this is let's make it a short, very short. Okay, so this is 500, this is 500, and this is 500. After that, let's not have it. Okay, so there's another project which has 0, then 500, then again 500, but after that this 2000, then 1000, something like that. So when we calculate the payback period, A will have a payback period of 2 years, but B will have to wait for 3 years. So on that context, we would reject project B and go ahead with project A, because if there is an option to select only one based on the payback period calculation, project A would be preferred because the payback period is earlier than the one from project B. But the overall profits which are earned from project B are much higher as compared to the profits from the first project. So, and because the profits are earned little later at a later stage in the life of the investment proposal, that part is not considered at all for the decision whether or not to accept it. So becomes a disadvantage of payback period. So here when we look into that, the total profits which are earned by project A is only 1500, but the total profits of project B are 4000. Yet project A will be selected because it has a shorter payback period, 2 years, but this one has a payback period of 3 years. So that again is another point or a disadvantage. Very specifically, it's a disadvantage. Payback period ignores the timing of cash flows within the payback period. Okay. I said we will see. I was trying to paste the question and then it got stuck and I had to shut down. Okay, done. Quickly. No one else joined. They're not interested.
Mama texted them, but no one responded.
Okay. I think these professional programs are kind of scary thing for many students. They don't come forward so easily.
Yes, ma'am. Maybe. Now, it's not the first time we have had ACCA lectures back in 2022, March of 2020, but many of the students, like, there are only 6 or 7 ACCA students in Galgadu's University.
Okay.
But most of them don't attend the lectures.
But they enroll themselves into these programs, isn't it?
Yeah, yes, ma'am. But that's at their own discretion. Ma'am, can you please give me just 2 minutes break?
Yes, 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 yes.
I'll be back.
Yeah.
Yes, ma'am, you can start now.
There's a question here on the screen, 97 question number. So I just wrote the solution. Here we have profit before interest and tax, profit before taxation, profit after tax. There are three different forms of different types of profits are given: before tax, interest and tax, before taxation, and after tax. And then we have the information in addition extracts from its latest statement of financial position are as follows. So equity. Non-current liabilities. Non-current liabilities are long-term liabilities or debt capital. So equity and debt capital, both of them are there. So the question says that what is each company's return on capital employed? So return on capital employed is equal to EBIT divided by the initial investment amount. Take the profit before interest and tax, which is 2,500 divided by 10,000 and 2,500, 12,500. So the percentage is 20%. So if no other thing is mentioned, we go ahead in this particular. This is also an acceptable formula, but it is not very commonly used in financial management. Yes, this is the one which is used in management accounting. Financial management, it because it goes ahead with that assumption of taking only the profit after taxes. So arriving at that value of profit after taxes, whatever is the given information, we proceed further in that particular fashion and take that formula. If you refer to any FM textbook, you see the other formula only, not this one. Um, there's another question on the similar grounds. It says that a company undertakes a project that involves purchasing machinery at a cost of 65,000. The machinery is used on the project for 5 years, generating operating cash inflows of 20,000 per year. Yes, Sridhar.
Ma'am, when calculating ROCE, do we multiply it by 100? Like,
Ah, because it's an expression, no percentage. So when we just simply take 2,500 divided by 12,500, the value would be only 0.2. So because it is in Excel, I just press this one. So it
okay.
converted into percentage. So you just have to multiply it into 100.
Yes, ma'am.
Take this one as into 100.
Okay, ma'am.
98, question number 98. The company undertakes a project that involves purchasing a machinery at a cost of 65,000. Machinery is used on the project for 5 years, generating operating cash inflows of 20,000 per year. It is sold at the end. It is sold at the end of the project for 10,000. Taxation is charged at a rate of 30%. Calculate the initial return on capital employed for the project to the nearest whole percentage. Initial return on capital employed. So, initial return on capital employed, the formula would be the profit before interest and tax divided by the initial investment, like just like the 97th question. So that's the formula of ROCE. Now the numerator profits before interest and taxes. What have we given? What do we have in this question? The machinery is used on the project for 5 years, generating operating cash inflows of 20,000 per year, and there is a tax rate of 30% which is given. Operating cash inflows. So the term what is mentioned is operating cash inflows. So cash inflows, from that, cash inflows are kind of revenue or sales, something which is flowing into the business. So cash inflows. From that, all expenses have to be deducted. But there's no other mention about any other expenses. But only one thing what we can identify here is the amount of depreciation can be taken up. So the machinery cost 65,000. The life is for 5 years. There is a salvage value of 10,000. So calculate what is the amount of depreciation. So take the depreciation and deduct it. So for all the years 1 to 5, it would be the same because it's the same cash flow. What is cash inflow?
100,000.
20,000. No?
100,000. Okay. For
Okay.
the whole of 5 years, it's 100,000.
Each year, it's the same thing.
Yeah.
Then less depreciation. So we need to know what is depreciation. So depreciation, how do we calculate? Is equal to take the original cost, which is 65,000, minus the salvage value, which is 10,000,
10,000.
divided by 5. Okay. So for each of the years, it is
9,000.
is that 11,000? 65,000
9.
minus
9.
10,000. No, how much did I write? 65,000 minus 10,000, 55,000 divided by 11,000. So profit before tax, profit before tax. Okay. The point here is it is not the salvage value. It is about the, another student has joined. It is sold at the end of the project for 10,000. So when it is sold at the project, it is not a, it has a sale value as 10,000. They are not mentioning that at the end of the life there would be some the, scrap value, that is after they sell it away they can realize some minimum value, that like in the previous question it had 100. The scrap value was 100 here. We've done that. So it is only some minimum value. When 3.9 million was the investment made, some very minimum amount of salvage value was there. Here it is not, they are not talking about the salvage value, they are talking about what is the sale value at the end of the project. That is for 10,000 they have realized when they have invested 65,000, out of which they have realized amount of 10,000. So there is an assumption which is taken up here. Let's work it out this one first. So cash inflow minus the depreciation amount regularly. So the ROCE would be, here what do we have? We have 9,000. The initial investment is 65,000. So the percentage of ROCE is 13.85%. There's another variation for ROCE which says that because it is sold at the end of the project, so they have technically provided depreciation only for 4 years. So that is one way of looking at that. So the 5th year, the last year, they are not looking at what is the cash inflow and the depreciation amount. So they are not verifying whether they have a profit. They're just selling away that one. So there is no accounting of the cash flows in the 5th year. So it would be, ROCE would be, every year they have a cash inflow of 9,000 but the depreciation would be provided only for 4 years, not 5 years. So that's the only point what we have. So here in case of the second format of ROCE, so depreciation here instead of 5 years, it would become only 4 years, because the fifth year they are they are selling it away and not having an account of or usage of this particular asset. So that is another assumption here. So this one and that one, anything which you do, you would be your calculation would be considered correct. See, it is more than the numerical answer. The understanding of how to apply a particular formula or method is what will be considered. So here in this case of ROCE would be the profit before tax is 6,250 divided by 65,000. So this is also correct. Both of them are valid and accepted. Okay, we'll go back to the PPT. The investment appraisal techniques, there are two different types of techniques is what we have discussed. One is the traditional techniques, the other one is the discounting techniques. So first, the ones which we have done, payback period and ROC, they do not consider the time value of money. But what is time value of money? Time value of money is based on an principle in economics, discounting principle of economics. It says that as the time passes by, the value of money decreases. Why would that happen? The You also must have heard from your from the elders in your family that in when they were young and they were able to do so much with 100 rupees, but 100 rupees is not worth anything. So even great grandparents, if we understand, we have them from their talks, we understand that 1 rupee also was very valuable in their times. So they were able to do so much more with 1 rupee. Of late, so we don't even consider that there is some currency called as 1 rupee only. So that is almost we do not even use it for anything. So why did what happened to this one? What is the reason that we see that? Because whatever the power that currency had, that quantity of money had, that is no longer there because it was decreased, discounted. That the to compensate for the decrease in the value, quantity of money had to be increased. So if it was not possible with 1 rupee, 1 rupee was replaced with a higher quantity of money, 100. The logic behind that is, let's say that if there is a person with an amount of 100, if he deposits in a bank, so this is at 0 year, by the time 1 year passes, and then let's say that the interest rate is prevailing interest rate is 5%. Let's assume that one. So after 1 year, what will happen to the investment? The investment will become 100 on 100. There is an interest percentage of 5% calculated and added to this. So 100 into 5% is calculated and added to his initial investment amount. So this becomes 105. So whatever an individual has in 0 year, this is worth 105 after 1 year. So the value of money to have um, the power of this 100 after 1 year, if someone has 105, this 105 is equal to 100 in the past, or if you are looking into the future, this quantity of money should be compensated with a higher quantity of money. This is the logic behind that. So we say that as the time passes by, the value of money decreases and the quantity of money increases. So this part of it is incorporated or included into investment appraisals. So investment appraisals, what is the decision criteria for the investment amount made as on today? The cash flows are earned. Um, the cash flows are earned in the future. So from future, uh, whatever are the anticipated cash flows are considered. We compare them. What is the investment today? What are the cash flows in future? And then take a decision. But then, if they are anticipated, let's say the 10,000 is anticipated to be received after 1 year. According to this, after 1 year, if it is 10,000, as on today, it will be less than 10,000, because 105 after 1 year is only 100 today. We see that. So if 10,000 is anticipated for each of the next 5 years, so every 10,000 will have a lesser value as on today. So the quantity of money or the amount and the value it would have will be less than what it is expected to be received. If 10,000 is expected to be received, it will have a lesser value depending on what is the cost of capital, considering that. So that is included into these investment appraisal techniques. Under that, we have the net present value. Okay. The formula is explained here. Compounding calculates the future value. So the future value will have um, the principal amount into 1 plus r to the power of n. So if it is at the end of 1 year, we see that it will be calculated as 100 plus 100 into 5. What if it is second year? One more time interest will be calculated. 100 plus 100 into 5 percent plus 100 into 5%. So 100 into 5%, here it is only one time, here it will be two times. This can be written as 100 is taken as common. So into 1 plus 5%. So as many number of years for which the interest is calculated, we have it there in the power. So here if it is only 1 year, the power will have 1. If it is 2 years, it will have 2, 3, so on. So the same formula is explained here in the next page. F is equal to P into 1 plus R whole to the power of N. So future value, present value, rate of interest and number of periods. Yes. Yes, Rita.
Nam, did you share these PDFs on my mail that I shared yesterday?
No, I'm really sorry.
No,
Because,
no problem, no
no,
problem.
no, no, the session was handed over
Yes,
to
ma'am, I know, I
another
know.
madam, and then I just closed it without even noting down your.
No worries, ma'am, no worries. Should I
Okay.
write it
Once
again
again,
in the chat box?
once again, please put your mail ID.
Okay, just a second.
Okay, I got it.
These notes are for the exam session 2021, right?
Huh.
Okay, okay.
So 2021 is the is okay. I'll share 2021 only. This the one which is displayed on the screen is
This is, I think, the integrated workbook, I guess.
the one which we are looking at.
Yes, ma'am.
This
It's,
is
I
PPT,
think,
not integrated workbook.
okay.
This is only the PPT, which we take it as easy, handy tool to because it's an online class and we have to present it. We are using this one. Integrated handbook is another one. So you also want the integrated handbook?
Ma'am, there, I think, one's the study text, and the second one is the exam kit, and the third one is probably the integrated workbook.
Okay, so you want all of them? Fine. I will share all the three of them.
Yes.
So, based on the formula, if we are talking about what is the future value is calculated as P into 1 plus R whole to the power of n. But what if we have to find out what is the present value as on today? The present value as on today would be this 1 plus R whole to the power of n goes to the other side. P is equal to F in F divided by 1 plus R whole to the power of n. Fine. So the discounting factor is 1 divided by 1 plus R whole to the power of n. If it is taken to the numerator, it becomes minus n. But the discounting factor is 1 by 1 plus R whole to the power of n. Under this, the techniques what we have are, first one is net present value, second one is the IRR, third one is profitability index. So what does net present value talks about? So the future cash flows which are anticipated. Now the cash flows would be in this particular fashion. The first year, the present, that is 0 year. 0 year, there is an investment made. So we see there is cash outflow. Cash outflow is a negative figure. Then starting from year 1 until year n. Okay, so the cash flows are cash inflows. Okay, cash flow for the first year, cash flow for the second year, so on, and cash flow for the nth year. Step number 1 talks about, first we need to find out what is the present value of all the cash flows. These are expected, anticipated cash flows from the future. So these cash flows have to be converted into what is the present value as on today. So today's investment will be the same, but the cash inflow after 1 year will have a lesser value. We've already looked into the logic about it. So take the cost of capital, the percentage at which these cash flows have to be discounted, considering that all these cash flows have to be discounted, and we find out the discounted value or the present value of cash flows. Present value of cash flows have to be calculated. So we would have the discounted cash flows starting from first year till the nth year. So all the discounted cash flows for all 1 to n years is taken. So that is present value cash flows after tax at R% for n number of years. This is compared with what is the investment. So when these two things are taken, the inflows minus the outflow is net present value. Net is after deduction. So the formula goes like this. NPV is equal to NPV is equal to, see, the present value of cash flows, present value cash flows after tax. All these cash flows have to be discounted. I will also show you how to calculate the discount rate in the Excel sheet. Now, this is taken at R%, discounted at R% and considered for n number of years. R%, n years minus, because it's net, no, it's minus the present value of cash outflow, because today's value would be the same. We generally do not write present value of cash outflow. We just go ahead and write it as cash outflow. So from the cash inflows, when the cash outflow is deducted and yet it is a positive figure, after that, when it is a positive figure, we accept the proposal, otherwise reject it. The logic is these are all cash inflows or the benefits. When the benefit exceeds the cost, the project has to be accepted, otherwise it has to be rejected. So that is the logic, a simple logic. The another variation of NPV is, we call it as PI, profitability index. The same thing is presented in the fraction format. Here it is a difference between these two. PI is equal to, we have the present value cash flow after tax divided by the cash outflow. That's it. Okay, so that's another variation. We use it profitability index in case of taking decisions about capital rationing. Uh, there is no one simple question where we can take it up, but when we discuss and solve cases, at that time we can look into that. This is the logic behind that. Then it says that annuities and perpetuities. An annuity is a constant annual cash flow for a number of years. So, if from year one to year n, if it is the same amount of cash flow which is anticipated, we can have the calculation simply done in one step instead of spreading it over 1 to n years. That is annuity. So, the formula says that the present value of an annuity is found using the formula annual cash flows into 1 minus 1 to the power of 1 plus r whole to the power of minus n divided by r. Okay, the formula is given in this particular fashion. But what if it is for perpetuity? Perpetuity is infinity. Infinity is anything to the power of infinity is 0. Anything to the power of infinity is 0. So 1 minus 0 will be divided by r is equal to just 1 by r. So if in case we see that the cash flows are for perpetuity, we discount the cash flows by just simply taking it as 1 by r. Otherwise, it is 1 by 1 plus r whole to the power of n, because n is not there, n is infinity. Anything to the power of infinity becomes 0, and then we are just left with 1 by r. Just remember these points.
Excuse me.
Yes.
Mama, inside the white box, it's written P is equal to annual cash flow into 1 minus 1 plus r raised to the power. Is it minus n or n?
Minus n.
Okay, okay.
Because otherwise it is there in the denominator, it is brought up to the numerator, so it is there in the denominator 1 by 1 plus r whole to the power of n. The discounting factor is there in the denominator, so that when it is brought up to the numerator it becomes minus n.
Yes, ma'am. Yes, ma'am. I know that. Know that. Okay.
And then comes um, delayed advanced annuities and perpetuities. Sometimes some of the projects it is better that they are not started immediately, but they wait until a particular point of time and then they start. The projects are delayed or deferred. Maybe the project is not well known among the customers, or there is some more time wherein the familiarity would be there among the customers, or technological advancements. So they also can be well equipped with certain other resources, and also certain cases instead of starting the project immediately it is deferred or delayed to so as to get the benefit. So from the time it is started and the cash flows are started to earn, so those things all of them have to be calculated from the time of starting that and bring it again to the present value. The decision will be two steps. So from the time of starting, we find out what is the present value as on that date and bring it back to present date. So that is what we have to do. So some of the projects are delayed. Some of the projects which are supposed to be started in future can be advanced and started immediately. So that is also another thing. The next one is internal rate of return. So internal rate of return, if we talk about IRR is R. R is what we are talking about. It talks about a rate. The logic about discounting factor is the cash outflows, the all the future cash flows. So net NPV, what are we doing? We're taking the cash flow of the first year, and then discounted by the rate of return, that is 1 plus r whole to the power of 1, isn't it? So then if it is the second year, we have cash flow for the second year divided by 1 plus r whole to the power of 2. So on, we take it up until it comes to the nth year. Plus we see the nth year, it is Cn divided by 1 plus r whole to the power of n. Under NPV, the set here, this one, the entire set is taken. From this, we deduct the cash outflow and then we see whether it is a positive value or negative value. So that is what is done under NPV. IRR says that the rate at which the cash flows when they are discounted, the sum total of all the cash flows should be equal to the investment amount. The sum total of all of them should be equal to the investment amount. So the equation, when we present it, it looks like this. The cash outflow should be equal to all the cash inflows which are expected to be earned from year 1 till the year end, when individually each of them is discounted at a rate. So what are we looking at is at what rate when these cash flows are discounted, the sum total of it should be equal to cash outflow. So the equation is not a very simple equation wherein we can very easily bring out R and find out what is that. It is spread across n number of periods. So, and that too, it is there in the denominator, and there is a to the power of, so exponential is also there. So in that case, to bring out R out of the equation is not an easy task. In such situation, how to calculate IRR is based on a trial and error method. So since we cannot simply and directly calculate what is R has to be calculated in a trial and error method. So the internal rate of return, the rate of interest or discount at which NPV is equal to 0. When will NPV be 0? When both of them are equal. The cash inflows, the discounted cash inflows and the cash outflow. When both of them are equal, we would have a NPV of 0. Otherwise, either we will have a negative value or a positive value. So since we cannot straight away calculate R, what is done is select some percentage, assume some percentage and discount the cash flows to verify whether NPV is 0. So very rarely that very precisely we can arrive at that value. So first trial, if it says that the NPV is a negative value, so the discount, another discount rate, a lesser discount rate has to be taken. By discounting at a percentage, more amount got discounted. So we have a negative figure. So we select a lesser value of discount rate and try it out. So once we have one set of NPV at a positive value, one set at a negative value, then we take up the interpolation. So that the formula looks like this one. Interpolation says that IRR is equal to the lower rate. Since two rates would be selected, one at a lower rate, one at a higher rate. So with one rate, we would get a positive NPV, another rate, we would get a negative NPV. So the one which is at a lower rate, take that lower rate. So suppose 5% percent and 8% are these two rates which are selected. So between the two, which one is the lower rate? That is 5% is the lower rate. So take 5% plus NL is there in the numerator. What is NL? NL is NPV at the lower rate of interest. So at this 5%, whatever is the NPV value, that will be there in the numerator. Denominator has the difference between these two rates, the NPV, the difference between NPVs at these two different rates. So NL is the NPV at the lower interest rate. NH is NPV at the higher interest rate. So we just take the difference between that. That is a delta. Difference is taken as a delta, not a negative sign. It should be taken always as a positive sign. Fine. and into in bracket we have the difference between the rates, that is now here the assumption 5%, 8%, so difference between 5% and 8%, that is again a delta. So 8% minus 5%, 3% has to be taken. So using this interpolation formula, we calculate what is internal rate of return. Here also, as far as I have seen, I did not find any IRR question. Okay, so that's the logic about now examination. The cases will have questions like what is NPV, what is IRR. So numerically, when we work out the problems, it is easy to do that. It is doable. It is not a difficult task, but students find it very difficult to present this answer in their own words. So write what is the meaning of IRR, what is the meaning of NPV in your own words is the task there, which has to be taken up. NPV at least can be answered, but what is IRR? Somebody asks. So you should convey the meaning about what is that method. So learn the concepts about it. Then for each of these methods, for all the methods, the payback period, the ROCE method, then we have NPV, IRR. What are the advantages? What are the disadvantages? Have to be looked into. NPV, we have the absolute value, that is the amounts are given. So the total present value given in dollars, dollar value, minus the present value of cash outflows. Okay, that is also in currency form. So um, it is easy to understand. Okay, understand that whether there is a positive figure or a negative figure, but it is difficult to use it as a comparison. Higher the amount of investment, higher would be NPV. Okay, lower the amount of investment, lower would be NPV. So we cannot use them for comparison. NPV is not useful for comparison. So some other advantages and disadvantages we'll discuss. It considers time value of money. NPV considers, IRR also considers time value of money. It is an absolute measure of return based on cash flows but not profits. Only ROCE considers profit. All other techniques consider cash flows. So cash flows is it's an economic profit where we are also discussing about the opportunity cost, that is the benefit about considering the depreciation in its right sense, that is there is no cash outflow on account of depreciation, so that part of it is considered and the profit is calculated. So that is considered here when we take cash flows after tax. Only ROCE talks about profit before interest and tax, or sometimes it is also profit after tax. It considers the whole life of the project. It should lead to maximization of shareholders' wealth. So NPV, IRR, and all, they focus on maximization of shareholders' wealth because the real value, the present value of the cash flows are considered. All the other adjustments are made, and then the cash inflows are taken for comparison with the cash outflow. Higher discount rates can be set up for riskier projects. So how should these cash flows be discounted? Generally, we see that whatever is the average cost of capital, weighted average cost of capital, will be taken as the discount rate or the prevailing discount rate in the market. So that also can be taken as the rate at which the cash flows are discounted. Suppose if we understand that the project is a risky project, for such risky projects, the discount rate is at a higher rate. It is taken at a higher rate to ensure that the investment proposal is not taken in the optimistic sense. So to be cautious about it, higher rate is considered and it is discounted. Disadvantages are not easily explained to managers. So some of the managers are from non-financial background. They do not understand these things, these technical terms, and it is difficult to explain it to them. These techniques are difficult to be explained to them. Then requires the cost of capital is requires that cost of capital is known. And in case of IRR, the advantages, time value of money, a percentage is easily understood. So what is the percentage of profit, a percentage of return, something like in converted into percentage, it is easy to understand. It also can be used for comparison. So some one project has 9% IRR, another project has 10% IRR, so one which has a higher percentage will be preferred. um, it considers the whole life, it does not need to know, need that cost of capital is known. Then the a company selecting projects where IRR exceeds so the decision criteria is when IRR exceeds cost of capital, then the project can be accepted. So that is the decision criteria. So one MCQ we have done. So it was given as ROC should be greater than cost of capital. It is IRR should be greater than cost of capital. Disadvantages is it is only in a percentage form, not in an absolute form. Small projects with high IRRs might not enrich shareholders, such as much as large projects with small IRR. Small projects, the life also would be a smaller period, and even if there is a high IRR also, it is not considered so much preferable as compared to a project with a higher duration and a smaller IRR. Then interpolation only provides an estimate. So that is only an estimated value. We are assuming that IRR would lie between the lower value and the higher value. So it is only an estimation. Then another thing is when there are when cash, there is only one cash outflow, one negative figure, then we get one IRR. But if it is not necessary that there would be no cash outflow during the later parts of the project. So in the later years, if there is any additional investment made, we see cash outflow is again another negative figure. So when we have multiple cash outflows, IRR also we would have multiple IRR. So it is not reliable in such situation. If there is only one cash outflow versus cash inflows, then it is possible to calculate what is IRR, but otherwise it is not a reliable one. Next one is NPV with inflation. Okay, NPV with inflation is a situation where the prices rise. So because of inflation, um, there will be an impact on the rate discount rate also. So in case where there is inflation, NPV can be calculated. It says that it does not include in inflation rate of inflation is not included. And then we see another method where the rate of inflation is also included. So that looks like this one. The formula is real and money rate. So the discount rates may exclude inflation. When the inflation rate is not included, it is excludes inflation rate. We call that rate to be as real rate. But once the inflation rate is also incorporated, we call that as money rate. So the question can be asked to calculate what is money rate, and after that, the cash flows are discounted. So we see that without including the discount, the inflation rate, the rate which is taken is called as the real rate. But once the inflation rate is included, it is called as money rate, and the formula is 1 plus R is equal to 1 plus I divided by 1 plus H. H is the inflation rate. So we need to calculate that in this particular fashion. Remember this one and make a note of this one.
Excuse me, ma'am.
Yes.
Can you hear me?
Yes, Sridhar.
Yes, ma'am. I was saying, ma'am, if you don't mind, can we stop the lecture for today?
Absolutely. There's another
Uh,
student also in the class.
yes, ma'am. Vikalp is there.
Find out
Hasn't
from him also.
Ma'am, he hasn't connected his audio.
Okay, no problem.
Ma'am, we'll join in at the same time tomorrow, right? Is there is there a lecture on Saturday?
I don't know. It should be there.
Okay, ma'am. If there is, you can. I'll attend.
So the spelling is SREEDHARVIGNESH 044.
Yes, ma'am. SREEDHAR. DHAR.
Yeah. So you want 2021 material, isn't it?
Yes, ma'am. Yes, ma'am.
Okay. I'll send it.
Okay.
Okay then.
Bye, ma'am. Take care.